Good afternoon and welcome back to another Money Not Math conversation. It is Thursday, July 28th, 2022, and today's topic is the cost of trying to time the market. Let me ask you something. Are you excited to go fill up your car with gas when gas prices go up? Would you rather go on a vacation when gas prices are way down? I think the answer to both those are really obvious. And yet, when we talk about the stock market, people's actions versus the logic often completely contradicts itself. People, when the market goes way up, people are like, oh, I got to get in on that. I got to get in on that. I got to catch the wave. The problem is the wave already started. And now you're buying stocks at a premium rather than buying them on sale. On the flip side, when the market goes down, emotion screams at us, get out, right? And yet, when's the worst time to sell? When the market's down. So we always have to keep that in perspective of, we don't want to try to time the market ever, but if we're going to, definitely don't do it. I'm going to buy when the market's up and sell when the market's down, because now we're just guaranteeing ourselves of either buying when it's more expensive or selling at a loss. So we can use numerous examples on that. I know I've used some other ones before, but keep that in mind. Is it better to buy gas or stocks when the prices are low or when they're high? Now, I'm going to use a couple of examples of how the media and Wall Street manipulates you to try to get you to do the opposite of what they know that you should do so they can make money while you don't. All right, so I'm going to share my screen here. Here is an example of the S&P 500. All right, quick Google search, S&P 500. If you turn the news on today, they're going to say, it's the best day ever in the market. It's up 48 points, 1.19%. Okay, great day. It's even green. They manipulate you with your colors. It's green. That means good, right? We should get in. Again, the problem is this means that it is more expensive to invest in the S&P 500 today than it was yesterday. So is it a good day to buy or not a good day to buy? Now, if you're systematically investing, you shouldn't alter your actions. I'm just pointing out that when market timing is very dangerous, and basing it on buying when it's up and selling when it's down is almost a guaranteed way to hurt yourself. Now, if we expand this out a little bit and we look at a month, market's still up, good things are happening. That's awesome. Look at 6 months. Oh my gosh, doom and gloom, right? It's all red. But as we can see, up, down, up, down, up, down, up, down, up, down. It's the nature of the market. When we look at investing in the market over a long period of time, first we have to understand anything you put in today, you should know that you do not need that money for at least the next 3 years. If you need that money, maybe it shouldn't go in the market. But it's like walking up the stairs with a yo-yo. You're going to be from point A to point B, you'll be at a higher point, but the yo-yo is going to go up and down and up and down, and that's the stock market. Now, if we look at the last year, again, all red, doom and gloom, scary stuff. The last 5 years, all green. We're way up, right? So even right now, people feel like the market's way down because at one point, as we can see, it was around 4,800 and now it's down to about 4,000. But if we go back to just April of last year, it was about 4,000 then too. So we're basically flat from April to 2021. Now, if you go way back to 2020, we're way up. Or when it drops, we're way up from there. It was at 2,300 at one point, and so on and so forth. So we have to always keep in perspective, buy low, sell high, and timing the market is dangerous. And here's a quick video to illustrate that. For those of you listening to the podcast, I will say what the video is showing. But for those of you watching the video, you can just sound me out and watch the video itself. So the effect of being out of the market for even a short time can be profound. Missing a period of strong returns can drastically impact overall performance. If you had invested $1,000 in US stocks 25 years ago, how much would it be worth today? $10,367. What if you missed the best performing week? It'd only be $8,652. Or missed the best month? It would be $8,297. How about the best 3 months? $7,308. 6 months, $6,700. So there's no proven way to time the market. So maybe stay in your seat and let's not try. Those are some pretty profound numbers on how drastic it can be to miss the best days of the market and how dangerous it can be to try to time it. So Hopefully today's Money Not Math conversation brought you value. Again, timing the market is dangerous. And if you are going to try, remember, buy low, sell high, and don't do the opposite. Let me know what questions or thoughts you have. And thank you for your time. Have a nice day. Bye.